So this part of, I have a sort of a lineup of rapid fire slides. This is sort of like the visual portion of the presentation. So think about it like a Snapple cap of just ideas and facts and sort of things that we look at BI, how we think about the industry, some of the content that we write. I know everyone might not be able to see the charts, so if there's a topic you're interested in, all these charts are pulled up of content that we've written. So I can send you the deck, we can talk more about it. So I know not the way sort of it's set up, and you might not be able to see all of it. So there's a lot of charts, I'll get right into it. Sort of just to let you know where you can find our content on the terminal BI ETF. So there's sort of two main areas you should know. Is sort of in the middle of the page, there is all our relevant content that we're writing in our research, whether it's timely to what's happening in the market, a deeper idea that we'll go in more in depth, whether it's on factor investing or whatnot, all be posted there. And over on the left is something called the data library. So a lot of our charts are built off of the data through there. So there you can see fund flows by different asset classes. We also have active passive flows, right? So with the panel was talking about how the lines of active and passive are getting much more blurry. So we look at flows even within the context of mutual funds too. So that can be pulled up here. We also have a new tool, sort of holdings based. So if you want to look for a specific stock, you can put that in and see which ETFs hold that stock and what weight they have to it. And among other flows, we also have a new rating system that we launched. So we sort of rank all the different ETFs in the US that I'll go into here as well. So I'll sort of get started. And let's just start just with launches, right? There's always a lot of critics saying that there's 2,500 or so ETFs in the US. There can't be any more. But through August, to give you some context, this is the 4th busiest year for ETF launches. Right? There's just tremendous amount of focus, a lot of new products coming in. And also, what's interesting is also the breadth of launches. There's 50 sponsors have launched products this year. It's not just that there's one sponsor sort of building out a suite. But there's some specific areas that I think are really interesting. But gross launches is just half the equation, right? When you sort of look at it on a net basis, the industry is getting a lot more competitive, right? So incumbent products that aren't raising money are being shut down. New products that are coming out, they're being shut down pretty quickly. Like there's some products that have been out there for less than 2 years and they've shut them down. So on a net basis, actually, we're trending down, which is why you continue to see a lot of gross new issuers come out. So there's really a few areas that I think are really interesting. Commodities. This has sort of been the asset class that's been sort of out of favor for a long time. But what's pretty noticeable in the last 2 years is a pretty significant pickup in commodity product launches. So it sort of looks like either the issuers are sort of maybe trying to bet that commodities are going to start coming back, and they're sort of trying to take advantage of that, launching products. But what's going to be interesting is that when commodities do come back, there's going to be a whole new menu of options for investors that they really never had before. There's a lot of new issuers that come into the commodity space. There's a lot of new cheap options that have come in there. So when you sort of see, they've been so out of favor for so long, we kind of forgot what it was like. When it does come back, there's going to be a whole new set of options for investors. This area we're really excited about. It's sort of like this new generation of like fixed income ETFs, right? And traditionally, most of the assets and most of the products that have launched are in just traditional market valuated fixed income products, right? So like the ag and just corporate exposure. There's this sort of this new wave of what's called smart beta or enhanced indexing, this new wave of fixed income ETFs that, again, are a little bit more innovative in how they're picking bonds or how they're weighting bonds or they're employing like rate hedging strategies. So the yellow is just traditional fixed income ETF launches, right, like your ags and whatnot. The white and the blue are your active and your enhanced indexing. And I think this is important because there's not a lot of assets there yet, but when you sort of look at the active passive landscape, fixed income fund managers have been pretty safe. Like they haven't really seen a lot of the outflows that the active equity guys have seen. So now there's this whole new wave of fixed income ETFs that are coming out to really sort of take the brains of these bond managers and really put it into an index. So to kind of take advantage of that, we added this new feature, and it just went live last week. We sort of bucketed up these new fixed income ETFs. So things like rate hedging, defined maturity, yield enhancement, fundamental selection, and we have it now on the terminal to better track it. They're still pretty small, they're 28 billion, but I think this represents sort of where there's going to be a big focus going forward for a lot of the issuers. And this wasn't planned. Someone was on here, I think Dave mentioned about the active landscape. So it's still pretty small in the ETF world. It's about 1% or so of the assets are in active ETFs. But 2 years ago, the SEC sort of opened the door to make active launches a lot easier, sort of like this express lane for launching products. So there's been a huge uptick in active ETF launches too. With these, what's interesting, the market hasn't really adopted them yet, but when you sort of look at the breakdown, a lot of them are pretty new, so a lot of them haven't really established what's just called a 3-year track record. About half the market of active ETFs have less than a 3-year track record. So I think as we see more time develop, we may see some bigger adoption in active ETFs. This is a huge topic. Like, it gets covered a lot, but no one's really seemed to crack the egg on like ESG or crack the code on ESG. It's bigger globally, but here in the U.S., ESG assets are still really small. But there's been a huge uptick in active ETF or ESG launches, especially in the last like 2 years. These ones just are broad ESG ETFs, so it'd be like your MSCI World ESG. There's also like very much more niche ideas, so like veterans indexes or gender diversity. But ESG ETFs get a lot of attention, but the assets just don't seem to really be following there. Another big trend is sort of this doing it yourself, because it's just so uber competitive with fees that even issuers are even ditching index providers, a lot of them, and they're sort of doing it themselves. It's still relatively small. There's only about 250 or so ETFs that are self-indexed, but it's sort of like this growing trend that a lot of these strategies are just being built in-house. They're launching their own indexes and then products tracking their own indexes. So self-indexing is this trend that we're seeing also pick up a lot. Let's pivot over to flows a little bit, and sort of over the last year or so, sort of where we've been seeing flows. One explosion, and the chart's almost parabolic, is ultra short maturity ETFs. So these are like your short duration products, your cash-like ETFs. They're up to $40 billion, and they've always grown pretty well, but over with the last 2 years or so, with rates starting to come up, there's been a huge explosion in assets going into these cash-like or cash equivalent ETFs. And on the heels of that, what's benefited from that is these floating rate ETFs, right? The floaters, so FLOP, BKLN, VRIG. Over the last 3 years, $21 billion have come into these floating rate ETFs. It's pretty amazing. But what's also incredible is that every product in the last 3 years has taken money in. It's not just this one product taking all the assets. It's a pretty small universe, but $21 billion over 3 years, and that's $8 billion, almost $9 billion this year alone. So a lot of focus and a lot of money going into these floating rate products. Tech, right? You hear about tech all the time, but when you look at monthly inflows into tech, it's on a 14-month inflow win streak, right? 14 straight months of inflows. That's about $15 billion in assets. It's been on this tremendous win streak, one of the longest it's ever seen. But this year, it looks like that win streak, or for this month, it looks like it might actually stop. There's about a few $100 million that have left the door in tech this month. And when you're sort of looking at tech performance, is sort of starting to diverge from some of the other sectors, but flows are continuing to go up for tech. So it looks like that in September, this might be the end of tech's sort of flow win streak of 14 months, which is pretty incredible. This is sort of a stat that I started just running, and I thought it was interesting. It was sort of looking at, with yields going up, just how much harder has it been to pick like a fixed income ETF that's been making money. So when I first ran it, I looked at, all right, what percentage of fixed income ETFs have losses over the last year? And it was 60%. So at first that number didn't mean anything, but then when I sort of looked at it historically, it's one of the highest readings we've ever seen, and there's a lot more products. So it's just showing that it's been pretty hard in the last year or so to make money in some of these fixed income ETFs. It's a stat we started running, and we got a lot of good feedback on it, so we're going to continue to keep running it. Someone was talking about single factor and multi-factor ETFs. So 2018 has been this huge year for multi-factor ETFs. A lot of new sponsors have, a lot of them have their single factor suites, but a lot of them have now come with these sort of fusing these factors together. And what's happening for the first time ever is that multi-factor is leading the flows over like the single factor ETFs. So traditionally it's always been like low vol did good 1 year, momentum, value, but this year sort of there's a lot of money gravitating into the more multi-factor suite. So it looks like this year they're going to be the leading, we still have 3 months left, but they're already ahead pretty well over some of the other factors. So it's going to be probably the first year that multi-factor is really going to break out compared to single factor flows. Let's talk about what some things that are not doing so hot. Europe, right? Both broad Europe ETFs and even single country European ETFs have just been struggling. Really, it's been awful for them. It's 6 straight months of outflows. And not only just the big traditional unhedged products, but even the currency hedge products have seen a lot of outflows. It's just been really tough for Europe. Eurozone products, single country European ETFs have just had it pretty rough over the last couple of months. This is a pretty interesting stat because dividend ETFs has always been like this staple of inflows. Like even if rates go up, there's sometimes a knee-jerk reaction in flows, but dividend ETFs have always sort of constantly taken in money. But this year, it looks like it's going to be the first year that dividend ETFs are actually going to lose money. Again, there's still 3 months left, but typically they've done so well, but maybe with the fear of rates going up, it's going to be probably the first year that we might see some outflows in some of the dividend products. This is a stat that we started running too. It's when we look at flows of the sponsors, we also started looking at the volatility of flows, right? And we find some pretty interesting things is that it's like something early in the year in February when the market was going down and people started trading ETFs a lot more. When you look at volatility of flows, it's not consistent among all the different sponsors. So for example, at firms like Schwab and Vanguard, they're just very cheap market cap exposure. You don't see a lot of trading there, even through market volatility. But then there's some other sponsors that have some of these products that trade a lot more, like the sector products or levered ETFs. You see a tremendous amount of volatility in the flows with those sponsors versus some of these other ones too. But then we also looked at certain asset classes, fees too. But this is, I know there's a lot going on. It looks like just like a splattering of just lines here, but you'll see that it sort of speaks a lot to like investor behavior and sort of which sponsors maybe see more volatility in flows than others. Thematic was mentioned a lot up here, and this has just been like a smash hit this year, and not only in the U.S. but sort of globally. And I just picked robotics. It's just been they've been on a complete tear. But there's robotics ETFs, cybersecurities, infrastructure, tech disruptors. But to give you context, robotics are bigger than ESG just in the U.S. alone. There's more assets in robotics ETFs than there are in like all the ESG ETFs. There's about 8 billion or so globally. And what's interesting is in Europe, the biggest tech ETF, even bigger than broad tech or anything, is a robotics ETF. It's even bigger than the S&P 500 tech ETF in Europe. So I'm just using robotics as just a word of a gauge, but there's attracting a lot of new entrants into thematics too. A lot of the big traditional sponsors are getting into thematics too. So big area there, a lot of focus. They've taken in a lot of money too. Something was mentioned before, and I didn't plan this, like the stuff that was mentioned here, it's just sort of, now this is sort of just visually, like you can see it. The importance of just cost, right? And what this chart shows is the industry broken down by fee buckets, by 10 basis points, so 0 to 10, 11 to 20, et cetera. So if you sort of look at on the left side, products that are less than 20 basis points are only 15% of the universe. So 15% of the investable products are under lower than 20 basis points, but they control 65% of the assets, right? So there's just, there's this huge focus on cost that people have just been gravitating towards just the lowest cost products. But there's some other interesting stats there too that I'll show you about sort of this phenomenon that some of these really cheap products have been good performers too, which is sort of giving it this double tailwind. Oh, I'm going to go, does anyone know actually what the top performing ETF is over the last year? It's an Invesco product. It's unlevered. Yeah, so small cap healthcare, PSCH. It's up like 59% over the last year. Best performing equity ETF. And I always thought that this suite, these small cap S&P 600 seats, would be a lot bigger than it is. But I'm glad to see there's a lot of flows going into this product now. I think it has the biggest weekly inflow ever last week. It's just a random fact that it's just the best performing ETF. But sort of that speaks into a lot, and I looked at this stat of sort of about like investor behavior, right? And sort of, does the cheap product just attract assets, and that maybe feed into bad behavior? Now, we can make the argument that maybe this could be good behavior, but I sort of looked at these two different cases, which is sort of like this really cheap emerging markets ETF and the more expensive one. And I picked emerging markets just because it's been down a lot this year. So IMG is the really cheap emerging markets product, and EEM is the more expensive one. IMG has never seen an outflow ever. It's only just taking in money when EEM sees outflows and it trades a lot more. So even as emerging markets have been going down this year, money's still been piling into IMG. So you can make the case that maybe that's just dollar cost averaging, that's good behavior. But what's actually happening is that this cheaper product has actually we call it burning cash, or it's actually lost more money for investors than EEM, right? Than people that are not trading this emerging markets product. So for example, EEM is going down, but money keeps going in. So IMG has burnt about $7 billion in investor money from losses versus EEM, which is burnt only about 4. Right? So, but EM trades a lot more. So you actually see, you know, emerging markets goes down, people pull money out of EM. Emerging markets goes down, people put money into IMG. So there's sort of this, and IMG is a very cheap version of EM. So you sort of see like this weird behavior that money's sort of going into these really cheap products, and they're maybe sort of ignoring what's happening performance-wise. But then I took it even a level deeper, and it's a very elementary way to look at it, but I think it sort of pulled out some behavioral characteristics, since I looked at the industry by quartiles. So I broke it up by the cheapest quartiles and then the best performing quartiles, right? So let's say, okay, let's look at the products that are both really cheap and they're really good performers. Those are those on the left, right? So that's a good place to be, that you're cheap and you're a good performer. But what happens if you are a bad performer, but you're cheap? And that's the third one. So actually what you're seeing is that you could be a good performer, but more expensive compared to other ETFs, and you haven't taken in as much money as being a bad performer, but you're really cheap. And this sort of just looks at this whole phenomenon and focused on, everyone's so obsessed with cost, right? And sometimes in that whole top performing and expensive products, there could be some really innovative products there that sometimes get ignored. This is just a very random one, but it's just an area that I think is getting a lot of attention. The assets aren't there, but it's sort of like the sentiment tracking ETFs. So things like tracking corporate insider buying and selling, hedge fund filings. And there's now one that looks through Twitter and tries to pick out names that are bullish trending on Twitter. There's one that's powered by artificial intelligence that literally has like an army of analysts that are picking stocks. There's not a lot of assets there, but these get a lot of focus. So it's sort of this area that we're starting to really focus on a lot more, sort of these taking the mind of an analyst or taking the mind of a hedge fund and putting it into an ETF or a corporate insider. There's not a ton of assets there, but I think it's a really interesting area and sort of where the really good sentiment indicators too. So that we track pretty closely. Bringing this sort of all together, we launched this new feature this year called the Bloomberg Traffic Light, and it's really like a rating system. And what we do is we scrub through the entire universe of ETFs, and we look at, I'll show you all the different inputs, but we sort of rank them on a scale. And we're looking more at that sort of operational things. So like, how is the index weighted? How does the ETF track its index? Is there weird tax consequences? Is it an ETN or is it an ETF? We look at all these different inputs and sort of assign infractions to these ETFs or assign points to them, and then we end up ranking them. So just to give you some context, you're over on the left side, your green 0 would be your S&P 500 ETF that's fully replicated, right? And over on the other side would be your triple levered VIX futures ETN, right? That has a whole bunch of issues. So this is just meant to make you aware of some of the risks of some of the products that maybe just aren't apparent at the surface level. That you might just see the name and like, oh, okay, this is just this. But when you actually look at, there might be weird tax issues, it might get weighted differently than compared to other products. So we just make you aware of these differences. There's 11 different inputs. I can't fit them all here, but this the methodology is available on the terminal where you can download it and you can see how we actually measure it, the field that's being used to calculate it, how we assign the points, and then you can actually access the entire universe of ETFs. This is just a real-world example. Everyone remembers like XIV, which is the inverse VIX product that closed down earlier this year. This is just sort of where all the VIX products would have ranked, right? And we launched this. It was almost perfect timing. It wasn't intentional. Right after XIV closed, but then this would have shown how the VIX products have certain roll costs. A lot of them are ETNs, so there's credit risk there. It sort of flags all these and assigns the points, and all of them would have been assigned red in the system. But you can access it, so you can go onto the terminal on the BI ETF page, and then here you can see all the ETFs. So you can search it by sponsor, by exposure. It'll show you the ETF, the score it gets, and also we put what the flags were, right? We don't just say, oh, it has a 4. We also itemize out the different flags and let you know what's flagging it, and you can dig deeper into it. So that's available on the terminal that you can get, and also the methodology is available for for download too. But sort of just to recap, and again, if there's anything that someone's interested in or in the deck, I'm happy to share it. But you know, there's like the sort of the things we're really focusing on is sort of this new wave of fixed income ETFs that are coming out. We're really looking for someone to crack this ESG code. Vanguard is coming to ESG, not only here, but overseas too. Multi-factor ETFs have been a big focus too, that we're seeing tremendous flows. And, you know, and if there's any questions, you know, please let me know. Thank you.